Happy Monday, everybody. I hope you had a great week. Today is the 7th of August, 2023, and this is your Monday market update. Last week was a big week for eco data and earnings, and specifically jobs data. Let's jump in. Last week has a lot to report, and this week, though usually pretty dull, post-jobs week is anything but. So last Monday, markets opened with a modest rally, moving up towards but not through 4,600 on the S&P. U.S. eco data came in early, worried the soft and no landing crew, and brought markets back to the even mark before another one of those newly dusted off surveys that we've been noting lately. The Senior Loan Officer Opinion Survey, the SLOOS, reported tightening in lending and overall weakening demand for loans. Markets did shrug this off. End of the day, we saw some end of the month positioning, and the Dow closed up 0.25%, S&P up less than 0.25%, and the Nasdaq up about 0.25%. As July came to a close, quick recap of the month. For July, S&P made it 5 straight months and was up 3.2%. The Dow did try to make some history, but had to cut it short at 13 in a row, but it did end up the month 3.4%, and the Nasdaq having one of its best years ever so far, up 4% on the month. Quick note, in case you wanted to stay tuned in the bizarro world we've been in, this is from the priced in category. Recall that we've been talking a lot about earnings. Recall that energy was slated to be the absolute worst earnings sector, and they're coming through. But in the same world, energy, top performing sector in July, up 7.4%. Speaking of energy, in the numbers, if you take energy earnings out of the S&P year-over-year calculations, S&P earnings would be flat. You take out energy and healthcare, S&P earnings year-over-year are expected to be up in the mid-single digits. Okay, back to the week. Tuesday saw stocks open slightly lower as the market digested Chinese eco data and waited for U.S. eco and labor data. Goldilocks to a large degree. Fed heads got into it. They're back in action. Overall, there was news to come after the close. I'll get to that in just a moment. But for Tuesday, a bit of a yawner, some earnings, but overall, the Dow was up 0.25%, the S&P down 0.25%, and the Nasdaq was down about 0.5%. Before we saw the markets open on Wednesday, there was the reaction of everyone to the downgrade of the U.S. debt from AAA to AA plus by credit agency number 3, Fitch. Just a quick score, 2011, S&P caused major waves with the downgrade to AA plus from AAA. Markets reacted to that, then recovered, and then some, and this is where it remains. S&P is at AA plus. Moody's is still a AAA. Now Fitch is also AA plus. Overall, it did rattle some people, and markets did not like it, but according to most, nothing will come of this. Honestly, the news from Japan that they're considering suspending bank cards for elderly people if they've not used them in a while to prevent scams. Think cybersecurity. I thought that was more interesting than that. So it really means more to us in the long term than the downgrade does. So this and other general eco data had yields spike, and that was a headwind on equities and competition for the money. Markets had a rough day as far as recent day goes. For the day, Dow was down about 1%, S&P down 1.33%, the Nasdaq was down almost 2.25%. Thursday markets gapped lower as eco data was all over the place. Labor numbers continue to show tight markets, and that is not what the Fed and the no more hike people want to hear. So markets moved into some technical levels of interest as all eyes were to be on Apple and Amazon earnings after the close. Add that to the upcoming payroll numbers on Friday morning. There's a lot of movement, but in the end, not much to report on, but this is what I do anyway, report on it. Dow was down about 0.25%, S&P down 0.25%, and the Nasdaq down 0.1%. Another quick note on earnings estimates before I hit the labor markets again, wrap up the week, and preview the next week. I have mentioned that the bar was set pretty low this quarter, so it should come as no surprise that the percentage of companies beating estimates so far is ahead of norms. We also spent a lot of time last year watching price target changes. And there are a lot of these days. Last week, Shopify, JP Morgan took them from 70 to 72. Normal, right? Cowen, even a bit bigger on Moderna, downgrade. The target goes from 145 to 125. But really, how wrong do you have to be? Barclays moved Wayfair target from 40 to 85. Morgan Stanley took Adobe from 510 to 660. Not sure how they justify those changes, but we'll see how this pans out. That's just earnings for you. Moving to Friday's markets, the Goldilocks jobs numbers, along with a lot of earnings, had markets open in the green, and that lasted most of the day as everyone was so excited about the labor numbers coming in to support the market's belief about a soft landing and no more hikes. Amazon and Apple, whose earnings were thought to be the next near-term catalyst, good or bad, turned out to be on the good side, but not enough enough. Late in the day, all reversed course. By the end of the day, the Dow and the S&P both closed down about 0.5%. The NASDAQ was down about 1/3%. For the week, 4 of 5 down days and the worst week since March. The Dow was down 1.1%, S&P down 2.33%, and the NASDAQ was down 2.85%. This coming week will be busy, but is not as busy as it has been. Overall, let's continue to watch what one analyst calls the 3 pillars of the market rally. First, the soft landing or no landing camp. Next, the disinflation that we've talked about. And finally, the Fed is done camp. If these pillars start to show wear and tear, we can give some of this rally back. I'll keep this information on the videos, and we'll keep an eye on it. Normally, the week following non-farm payrolls is quiet. This week we'll get CPI and PPI, so not so quiet. The next inflation news installments: Thursday is CPI, Friday is PPI, and Friday will also bring another University of Michigan inflation expectation survey and consumer confidence numbers. Yes, earnings parade continues. Some big names for the economy. UPS and Disney are the main headliners, but a lot to come. Overall, this will be another big week of eco data surrounded by earnings, and I continue to believe there will be some easing of the market and some opportunities. We will focus more on earnings and valuations. Last bit of news before we close today: the January to May stock rally was a bit concerning, as everyone talked about, led by 7 stocks, while the remaining 493 in the S&P 500 did absolutely nothing. The move last month: 72% of S&P stocks traded higher. The top 5 only added about 33% to the index, and that's down. So in addition to my belief that we are still somewhat stretched on the valuation side, there are green shoots of good news. So for now, keep nimble, keep in touch. Please share this with others and check out the information on the website. Come back on Friday for the planning video. More good ideas to bring you, news to use. Until then, have a great week.